Picture this. Nations locked in a battle, not with weapons, but with tariffs. These are trade wars, where countries impose taxes on each other's goods, hoping to protect their own industries. The goal to make foreign products more expensive, prompting consumers to choose domestic alternatives. However, like a house of cards, the global economy relies on a delicate balance. Disrupt that balance, and the consequences can be devastating. We'll delve into the tumultuous world of tariffs, focusing on the seismic economic shockwaves triggered by former US President Donald Trump's tariff policies. From the bustling factories of China to the heart of Wall Street, the ripple effects of these policies have been felt far and wide. In 2018, the Trump administration unleashed a torrent of tariffs, primarily targeting goods from China. This protectionist approach, aimed at shielding American industries from foreign competition, ignited a trade war with global ramifications. Industries ranging from steel and aluminum to technology and agriculture found themselves caught in the crossfire. Global supply chains, meticulously crafted over decades, were thrown into disarray, leaving businesses reeling and consumers facing higher prices. The economic aftershocks were swift and severe, impacting not only the US and China, but also sending tremors through Europe, Asia, and beyond. In 2018, President Trump, with the stroke of a pen, unleashed a wave of tariffs primarily targeting China, but also impacting goods from allies like Canada, Mexico, and the European Union. This protectionist policy aimed to shield American industries from what he deemed unfair competition. The administration imposed tariffs on hundreds of billions of dollars worth of Chinese goods, ranging from electronics and machinery to clothing and furniture. These tariffs made Chinese products more expensive for American consumers and businesses. However, the economic reality proved far more intricate and unpredictable as the global economy braced for the impact of this trade war. China, the world's second-largest economy and America's largest trading partner, found itself squarely in the crosshairs of Trump's tariff policy. The administration accused China of unfair trade practices, intellectual property theft, and forced technology transfers from American companies operating in China. China, in retaliation, imposed its own tariffs on American goods, targeting key exports like soybeans, automobiles, and agricultural products. This tit-for-tat escalation of tariffs marked the beginning of a full-blown trade war, with both sides feeling the economic strain. While the United States-China trade war was the epicenter of this economic earthquake, its tremors were felt far beyond these two nations. Industries around the world, many with intricate ties to both American and Chinese markets, found themselves caught in the crossfire. The automotive industry, heavily reliant on global supply chains, experienced significant disruptions. The agricultural sector, a major exporter to China, faced retaliatory tariffs that severely impacted American farmers. Soybean farmers, in particular, were hit hard as China was a major buyer of American soybeans. Technology companies, reliant on global supply chains for components and manufacturing, also faced challenges. The impact of Trump's tariffs on China, the intended target of this trade war, was significant but not crippling. China, with its vast manufacturing capacity and growing domestic market, proved more resilient than some analysts had predicted. Tariffs did bite, slowing economic growth and impacting industries reliant on exports to the United States. However, China responded with a combination of economic stimulus measures, currency devaluation, and a strategic pivot towards domestic consumption. This diversification strategy aimed to reduce China's vulnerability to United States protectionism. While the United States-China trade war took center stage, Europe found itself caught in the crossfire, facing collateral damage from a conflict not of its own making. European exports to the United States, particularly in sectors like automobiles, machinery, and luxury goods, faced new barriers. The uncertainty surrounding trade policy disrupted business investment and dampened economic growth across the continent. The European Union, while seeking to maintain a united front, found itself navigating a complex geopolitical landscape. These tensions, simmering beneath the surface, added complexity to the transatlantic relationship. The shockwaves of the US-China trade war reverberated far beyond the shores of these economic giants, impacting emerging economies in Asia, Africa, and Latin America. These nations, often reliant on global trade for growth, faced a double whammy. Firstly, demand for their exports, particularly raw materials and manufactured goods, declined as the trade war slowed global economic growth. Secondly, the disruption to global supply chains created uncertainty and made it harder for these economies to attract investment. The trade war also highlighted the vulnerability of developing countries to the whims of global economic superpowers. The initial volley of tariffs launched by the Trump administration triggered a predictable response from China, setting off a tit-for-tat escalation that characterized the trade war. China, unwilling to back down, retaliated with tariffs of its own, targeting key American exports. The escalation of tariffs created a dangerous feedback loop, with each round of tariffs further disrupting global trade, raising costs for businesses and consumers, and fueling economic uncertainty. The International Monetary Fund warned that the trade war was a threat to the global economy. This trade war highlighted the interconnected nature of the global economy and the potential for protectionist policies to backfire. The year 2018 saw the usually stoic realm of Wall Street transform into a scene of chaos and uncertainty, as Trump's tariffs reverberated through the global economy, sending shockwaves across the international stock markets. The Dow Jones, the S&P 500, and the Nasdaq, barometers of American economic health, experienced a series of dizzying plunges and volatile swings. Investors, accustomed to a degree of predictability, found themselves navigating a treacherous landscape. The technology sector, often seen as a bellwether for the broader market, felt the heat. Companies like Apple, heavily reliant on Chinese manufacturing for its iPhones and other devices, saw their stock prices fluctuate wildly as the trade war escalated. The automotive industry, grappling with disrupted supply chains and higher input costs, also experienced market turbulence. The trade war, once a distant rumble, had become an economic earthquake, shaking the foundations of the financial system. The trade war's shrapnel ripped through the intricate web of global supply chains, leaving multinational corporations, the architects of globalization, scrambling to assess the damage and adapt to the new reality. Companies that had spent decades building efficient, cost-effective supply chains found themselves caught in the crossfire. Manufacturing giants like Boeing, heavily reliant on Chinese suppliers for components of its aircraft, faced delays and increased costs. Retail behemoths like Walmart, with vast sourcing networks in China, grappled with the prospect of higher prices for consumer goods, potentially impacting their bottom line and consumer spending. Some companies responded by exploring alternative sourcing options, shifting production away from China to countries like Vietnam, Mexico, or even back to the United States. The trade war exposed the vulnerability of global supply chains and the complex calculations businesses faced in a world of heightened trade tensions. Perhaps the most insidious consequence of the trade war was the erosion of investor confidence. The uncertainty surrounding trade policy, the unpredictable nature of the tariffs, and the tit-for-tat retaliation created a climate of unease that rippled through the global economy, making businesses and investors hesitant to make long-term commitments. Business investment, a key driver of economic growth, slowed as companies adopted a wait-and-see approach, delaying expansion plans and capital expenditures until the trade outlook became clearer. This hesitancy had a cascading effect, impacting job creation, innovation, and overall economic activity. The erosion of investor confidence highlighted the intangible but profound impact of trade wars. While the trade war raged on between economic titans, it was the American consumer, often caught in the crosshairs of such conflicts, who began to feel the pinch in a most tangible way at the cash register. The tariffs, designed to protect American industries, had the unintended consequence of driving up prices for a wide range of consumer goods. From washing machines and refrigerators to clothing and electronics, the cost of everyday items crept upward as the tariffs took hold. American families, already grappling with stagnant wages and rising healthcare costs, found their budgets squeezed even tighter as the trade war took its toll. Domestic manufacturers, facing higher costs for imported components and raw materials, were also forced to raise prices, further fueling inflation and eroding consumer purchasing power. The trade war, initially framed as a battle to protect American jobs and industries, was increasingly seen as a burden on American households. The impact on consumer sentiment was palpable. American businesses, particularly those reliant on global supply chains or exports to China, found themselves navigating a treacherous landscape as the trade war intensified. The tariffs intended to protect American industries often had the opposite effect, disrupting operations, increasing costs, and creating uncertainty. Manufacturers, heavily reliant on imported components and raw materials, faced a double whammy. Tariffs increased the cost of these inputs, while retaliatory tariffs from China reduced demand for their finished products. This squeeze on both ends of the supply chain left many businesses grappling with shrinking margins and difficult choices. Some companies attempted to absorb the higher costs, hoping to weather the storm without passing them on to consumers. However, this strategy proved unsustainable for many, particularly small and medium-sized enterprises with limited financial cushions. The uncertainty surrounding trade policy further exacerbated the challenges facing businesses. Small businesses, often hailed as the backbone of the American economy, found themselves particularly vulnerable to the economic headwinds of the trade war. With limited resources and less flexibility to adjust to rapidly changing market conditions, many small businesses struggled to cope with the tariffs' cascading effects. For small businesses reliant on imported goods, the tariffs translated into higher costs for raw materials, equipment, or finished products. These increased expenses, often difficult to absorb, squeezed profit margins and put pressure on businesses to raise prices, potentially putting them at a competitive disadvantage. Small businesses engaged in exporting also face significant challenges. Retaliatory tariffs imposed by China on American goods reduced demand for their products, forcing them to find new markets or scale back operations. The loss of established export markets created uncertainty and financial strain for these businesses. The trade war's impact on small businesses had broader economic implications. Small businesses are a vital source of job creation and economic activity. When small businesses struggle, the ripple effects are felt throughout the economy, impacting communities, families, and overall economic growth. The dust has settled on the Trump-era trade wars, but the global economy continues to grapple with the aftershocks. Tariffs and trade tensions have left an indelible mark, forcing businesses, governments, and consumers to adapt. Supply chain diversification has accelerated, with companies exploring alternative sourcing options. This shift has contributed to regionalization in global trade. Companies are shortening supply chains, sourcing closer to end markets. Rising transportation costs and geopolitical instability drive this trend. The WTO has been sidelined, raising concerns about global trade governance. The trade war highlighted the interconnected nature of the global economy and the high cost of protectionist policies. Tariffs aimed to protect American jobs but had complex global consequences. Manufacturing jobs didn't return as expected. Automation continued to change the sector. Tariffs increased costs for businesses and consumers, highlighting the need for international cooperation. Dialogue and diplomacy are essential for stability. The legacy of Trump's tariffs continues to be a subject of intense debate among economists, policymakers, and the public alike. Did the tariffs achieve their goals? Were the costs worth it? Some argue they addressed trade imbalances. Others say they harmed businesses and consumers. The debate continues. What are your thoughts? Share your views in the comments below.